So when you get a mortgage, there's a lien registered to the title of your home. And there's two ways that this lien can be registered. It can be registered as a standard charge, and it can be registered as a collateral charge. What I want to talk to you today about is the collateral charge and why you need to understand it. So a collateral charge, some people may say, has some pros and some cons. So the good thing about a collateral charge is it allows the lender to advance funds to you easily in the future. The downside of a collateral charge is it actually registers a lien to the title of your home, sometimes more than 125% of the value of your home. There are two things that happen when a collateral charge is registered. The first thing that happens is, because it's not registered as a standard charge, it's registered as a collateral charge, it makes it really difficult to move to a new lender upon renewal without an additional legal cost. It's a bit of a retention strategy from a lender to keep you there because it's now going to cost you money to move. If you had a standard charge, there's no additional cost to move to a new lender, but with a collateral charge, there's now a legal cost to move to a new lender. So again, a bit of a retention strategy here. The second thing that happens with a collateral charge is it grants the lender a whole bunch of power. The power to foreclose on the home, your home, in the event that any credit facility goes into default. So if you have a credit card, if you have a car loan, if you have anything else with the bank that has your mortgage and you have a collateral charge registered, it gives them the power to foreclose. The best way that I think I can describe this is in the form of a story, because I've seen it happen. So I'm going to refer to this as the red bank. So in this particular situation, there was let's call it a dad and an adult son. The adult son wanted to buy a car, but didn't have enough credit. So the dad co-signed the adult son's car loan. The car loan was with the bank that the parents also had their mortgage at. In this particular instance, the son was in an auto accident and wrote the car off. And for whatever reason, the son stopped making the car payment. Good choice or bad, that's not for us to decide. In this particular case, the son stopped making the car payment. The red bank now has the right, and they acted upon their right to now start foreclosing on the parent's home because there was default with the auto loan. Obviously, the parents didn't understand this and weren't aware that the bank had this type of power when they signed their mortgage. Most Big Five banks register or try to register their mortgages as collateral charges so that they can mitigate any loss moving forward for their non-securitized loans. So I don't particularly love collateral charges, but sometimes they're unavoidable. So if you have a home equity line of credit, you have to have a collateral charge. The point of this conversation is to understand that you have a choice. Big Five banks often register their mortgages as collateral, but there are lots of lenders that will only register a mortgage as a standard charge. And I think it's important that you ask the question, how is this mortgage being registered, and make the appropriate choice for you, not the bank.